Today we have on Kaledora from Ostium. Two interesting words that I just nailed because I got them right before. And okay, well, talk to us a bit about Ostium. You can give us a bit of background if you want, but wherever you want to go, maybe we could start with a little bit of your background and then just the overarching view of Ostium.
Yeah, background wise, I guess little co-founder history. Marco, my co-founder, and I met in college. First week of freshman fall in a macro econ class. It's a pretty big 600-person class, and I often say we were probably the two most opinionated people in the class, and eventually figured we should talk to each other rather than bothering the entire class. That's sort of the genesis story of the friendship and ultimately of the company. So in terms of sort of high level vision, maybe I'll start there and I can walk through a little bit more of the mechanics of Ostium. We approached it from a few different perspectives. So one, I think we started with a conviction that the most interesting problem to solve in crypto was TradFi trading or TradFi exposure on chain. Sort of that was, we had a pretty strong conviction that was the end game. And there were a lot of early experiments that we studied very closely. I think the two most obvious ones would be Mirror and Synthetix. In the last bull run, I think the numbers are pretty nuts on something like Mirror. I don't know how much of that is, not all of that is certainly real, but they had billions in open interest on Tesla and other stocks. So I think it was certainly too early, but there were certainly signals that eventually there was going to be some sort of demand, and it was quite clear to us that this was going to be a massive opportunity at some point. It just was a matter of the time, of sort of the market catching up and also the tech catching up. And as we studied the initial models, there was broadly, I would say, sort of the CDP model, or more of a pure AMM type model. The problem that we saw with those models was that it was effectively trying to take the not the circular tether model, but they were minting these ERC20 tokens or equivalents representing those underlying assets, but backing them purely by on-chain assets, which we didn't see as sort of a viable. It was evident that there was going to be a massive lack of capital efficiency. You saw that in the system. I mean, Synthetix initially backed it just with SNX. It was very, very over-collateralized. And the problem was, well, one, the sort of tokens representing those under, synthetic JPY or synthetic gold was sort of some of the early experiments would deviate wildly from the underlying asset because there wasn't a very good sort of minting. There wasn't a good system to really arbitrage it. And you couldn't mint and redeem it for the underlying. And then they were also very capital inefficient. And then they also didn't really serve the sort of needs or desired behaviors of users on chain, which is largely trading and sort of somewhat speculative in nature. You're effectively trading, a 1x, no leverage, can't short version of the instrument. And then it's also usually trading at some massive premium or discount to the underlying. And so looking at it, we developed a conviction that there would sort of be two big models through which people would onboard these traditional assets. One would be just properly going the fully centralized circle or tether model, the stablecoin model, and then just applying that to other assets, centralized holding companies, some minting or redemption process, and then some token representing that underlying asset. And that would make a lot of sense for an asset that you would either be using as a means of exchange or some store of value. So obviously, yield bearing, treasury instruments or dollar stable coins, or even something like Pax Gold that people would want to sit on as some store of value over a longer period of time. But that the model of just backing that purely, and you see this with stable coins with sort of the evolution of, DAI, it's become increasingly backed by non-purely crypto assets. And I that's certainly even more the case for something that's, gold or some other traditional asset that's not just a dollar. And then that would be sort of dominated by institutional players. We didn't really have an edge there. But that there would be another approach, which we didn't, really see anybody thinking about at the time. This is 2022, 2023, that we thought would be, both was probably a larger opportunity, especially over the next 3 to 7 years. And also where we saw no one focusing and we actually thought there would be massive sort of latent demand was a trading first product. So a perp or some perp-like instrument on those assets. Because one, it better serves, it's more aligned with what people are actually largely doing on chain today. And two, it's actually a much more efficient and faster system for onboarding an asset. If somebody wants to trade, if there's some crazy GDP news and I don't know, people want to trade copper, rather than having to open up some minting redemption facility and hold that asset and custody it, what you really need is a price feed. You need some makers, you need some liquidity system that'll allow you to list that, a funding rate or some other holding cost way of charging people to hold their sort of leverage position. But that you could onboard this asset much more easily through a perpetual or through some sort of perp-like instrument rather than through tokenizing it. So that's kind of like high level background. I maybe going even more sort of like philosophical. We thought that in like a post-COVID world, the macro environment had changed a lot, and that the traders or like the retail trader or the general like trader of tomorrow was going to be somebody who would be cross-asset by default and would not just want to trade a single asset or a single asset class. If you look at the early evolution of, democratized retail trading, whatever you want to call it, sort of post Great Financial Crisis, pre-COVID, the Robinhoods, the Coinbases of the world were all focused on basically a single asset class, crypto or stocks, whatever, evolving gradually over time beyond that, but largely focused on single asset classes and then usually a single instrument or some dominant instrument associated with that. Robinhood obviously started, with spot and making that really cheap to trade and fractionalizing it, and then ultimately pushing very heavily into options. But we thought that post-COVID, because macro is going to play a much, much larger role in driving volatility across asset classes. And you see this, I say macro news is the new reality TV. So this with the rise of prediction markets, Jay Powell has become a meme. People actually track the CPI numbers, like more, not just like complete market nerds, but more normal people are actually like tracking inflation. They talk about it. People follow geopolitics much more closely. It's a much more unstable world. And the natural downstream effect of that is that, people track this macro news, they want to trade on it. And importantly, the volatility within asset classes begins to be driven more by the sort of broader macro environment than by internal asset class dynamics. By that, I mean, like you just might be tracking a 4-year Bitcoin halving cycle. And so you're trading crypto based off of that. And we thought that would happen, and that sort of behavior change would happen slowly and then all at once and in a fractal way, where it was going to happen more broadly across sort of like Web 2, but also within crypto itself. And I think that's played out probably even more so than we initially anticipated when we developed this hunch. It's been a macro cycle. It's been driven largely by, also an institutional cycle. But the number of people who are crypto native who now have an opinion on gold or are trading stocks, and are doing this based off of like broader assumptions or beliefs about the behavior of the Fed or, U.S.-China relations is crazy. It's completely changed. It's a completely different, just even tracking the topics on CT, it's completely changed over the last several years. And so, I say all this because we thought there would be the winning sort of trading platform of tomorrow would be a place where people could trade cross-asset by default. You didn't need to jump through new hoops. If you look at sort of like traditional brokerages, you have to, you might be trading stocks. You want to take on some leverage or take on more risks. You got to figure out options. You want to trade commodities. You got to figure out futures. You got to jump through new hoops there. There are these sort of friction points each time you might want to trade a new asset class. And we thought having a single instrument and a single platform to trade everything from metals to energy to FX to crypto to single name stocks, indices, vol indices, all that stuff from one platform would be the winning form factor, both from like a, UX, whatever, like platform perspective and from an instrument perspective. And we thought that would happen. Like there was very clearly going to be an entry point within crypto itself, that crypto natives, people who had made their money in the space, but didn't want to off ramp for any number of, quite valid reasons, would ultimately still want to express views on gold or on, NASDAQ or on Tesla. But that you could, if you found an entry point initially in that market, ultimately you could springboard beyond that to a much broader market, servicing what I would say as this sort of broader retail demand for cross-asset exposure from, a single UI and through a single instrument. So that's sort of the broader vision behind Ostium. And started very sort of first principles and like worked back into the mechanics through that.
I've heard you maybe not describe Ostium so much as a perp dex. It seems like so this is how I've kind of interpreted it. It's more focused on like the synthetic aspect of assets versus like perps, right? Like, or the leverage aspect. So this is kind of like my interpretation from like reading about Ostium. It's more like we're bringing these on chain. They happen to have, baked in leverage if you want it. But the fact of the matter is like, it's more focused on like the synthetic aspect. Now, explain to me like what the model you guys chose. I know that, so there's perps, there's contracts for difference, CFDs, which have like existed for a long time. Like explain kind of the model. And I think maybe you wanted to talk about like how CFDs work and like maybe how this is a bit different or the similarities, and then also distinguish that with, perps as well.
So maybe I'll give a little bit of background on CFDs first, then I can sort of explain how the model works. So many people are unaware of the size of this market, but the contract for difference market is huge, does trillions in notional volume every month. It is largely the most widely traded retail derivative outside of the US and Indian markets where options are larger, and just simply because CFDs are not available. They're very similar to a perp. And I think that should give, anybody listening who's perhaps suspicious or not convinced that perps or perp-like, instrument on these TradFi assets might reach escape velocity, just look at the CFD market. And I think you have your, market data right there to validate just broader demand. CFDs are very similar. So they allow you to go easily long or short. It's a fully synthetic instrument. You can't redeem it for the underlying. It's all sort of settled in cash. It's a perpetual instrument. It doesn't expire. It's always rolled over. And so very, very similar. The big differences are that a perp in the proper sense has its own internal market dynamics that are reflected back onto the user. So you obviously have, a mark and an index price, you have a variable funding rate, and these are costs or execution prices that differ based on the internal market dynamics of that perp market. A CFD, on the other hand, abstracts that away. And the trade-off is risk and sort of delta exposure has to be managed on the back end on behalf of the sort of platform that's offering the instrument, because those natural market dynamics are abstracted away. And instead, the user is offered a much more predictable experience. So you don't have holding costs that will fluctuate wildly, and you don't have sort of a deviation between some mark and index. You don't have basically two prices or two things that you're tracking. You're tracking a single price. The way that they derive that single price is usually they're fetching prices from the underlying or some sort of aggregation of sources, and then they have their own pricing model. Not to get too much into the weeds, but when you look at different CFD platforms, they'll often have different account types. So they might offer an account that's, a zero spread account or a raw spread account. Raw spread meaning they don't add their own spread on top. Whatever they're getting in, let's say if it's on FX from the ECN market, they're offering you that price directly. They're not adding their own artificial spread on top. You have other accounts, but then there'll be fees. They'll typically be higher fees if they're offering you a raw spread. There'll be other account types where it'll be just their normal spread. So whatever their premiums that they're charging on top, they have there's not always too much transparency there, but then you might have zero fees. Often they also, because they want to incentivize different types of behavior. So for people who are trading over very short time horizons, they'll have this is most typical, but like broadly, a lot of account types will allow you to not pay any holding costs, except for if you've been holding your position. Either there's some threshold period after which you start to pay costs to hold your position. So you might just pay at entry, and at closure. So like they call them swap fees. So you might not start paying anything to hold your position. So imagine basically no funding rate unless you hold it overnight or unless you hold it longer than 5 days. So those sorts of things. So there's different account types. Like there's not one universal sort of model, but the way I would summarize what the sort of benefit of the instrument is, it abstracts away the need to track these sorts of like multiple prices and multiple dynamics that are unique to that specific instantiation of the market. Like if you're trading, if you're trading on Binance versus Hyperliquid versus OKX, the funding rates might be different. You're not just trading, BTC, like you're trading that perp that particular perp market on BTC. So the prices will differ slightly and the cost of holding it will differ slightly. And CFDs abstract that part away, which is part of why they're so popular as an instrument.
A quick question. Like in terms of CFDs elsewhere, are they primarily retail driven? And also, what does leverage usually look like on that? Like typical, I'm curious, like outside of crypto,
like
right? Is it like quite
levels.
high?
Yes.
Like
that's the other thing is it is completely insane. That was the other thing. I was listing the ways in which they're similar. That was the last, probably most obvious and important point that I failed to mention, which is insane levels of leverage, and actually insane even by crypto standards. Depends on the asset. Nice. They don't have universal like leverage levels, but I mean, on things like FX, I've seen platforms that'll have like 2000x leverage on FX. It's nuts.
Yeah, but is that because there's like less volatility to begin with, so people are like levering?
That's certainly
up?
True. That's 100% true. Like FX, I mean, people don't really want to trade, like retail generally doesn't want to trade FX at anything less than like 50 to 100x leverage. Frankly, because it's just like stuff moves like, a few basis points per day. Like it is nothing like crypto. So people want to trade in a lot of leverage. Obviously, like, the implied vol is like a lot, it's like a lot. Volatility assets is a lot lower, but 2000x is still a lot. So insane levels of leverage on FX often. It depends on the jurisdiction in which the instrument is offered. There's sort of different rules depending on sort of where you're onboarding and where your account is. But so in markets like the UK or in Australia, I think the leverage levels on most instruments are something like 30x, like 1 to 30. So it's a funny convention. Like in crypto, everyone says like 30x or 50x, but in sort of CFDs, everyone says like 1 to 500 or 1 to 50. I don't know. It's just like weird. There's some strange sort of like nomenclature quirks in crypto that are quite distinct that sometimes confuse people outside the space. But anyways, it'll depend. Like in those markets that are, more heavily regulated, the leverage limitations will be somewhat more restrictive, but you can also sign up through what they call basically like an offshore account, and the leverage levels will be often like pretty nuts. So very similar instrument in a lot of ways, servicing a sort of similar demand, but the core difference to keep in mind and understand is they abstract away those specific market dynamics that you would have to take into account. So the variable funding rates and the variable sort of, mark price as differs from the index price. And as a result, offer a much more predictable instrument to users. And this is particularly important as it relates to long tail assets, right? If you have like, if you want to trade lean hogs, there's like one big lean hog market. If you were trying to recreate your own, if you're a random broker in the Philippines and you got a few users here and there who want to trade lean hogs, most of these platforms, by the way, have like thousands of assets because they're designed to be sort of this aggregation of different instrument types across largely kind of aligned with like the vision that I was describing, which is like cross asset by default. But I mean, the amount of flow that you're going to get on like a lean hogs market on some like small broker in the Philippines is like really tiny. So if you had to have like, if you were trying to recreate your own market for that from scratch, I mean, you'd have no liquidity. So instead, you just need, the way that they go and they manage that instead is they continuously quote and stream a price that they're getting from the underlying market, or basically data providers that are fetching that data and aggregating it in their own way from the underlying market. And there's going to be quite inconsistent demand to go and trade that. But when there's significant size on that asset, then the broker will effectively internalize that and selectively externalize some of it, or selectively lay off some of that risk with a partner, basically through a bridge. They send it to a liquidity provider that they can hedge that exposure with, depending on certain criteria that they determine internally. So it might be, and every one of these calculates these things slightly differently. The way I'd broadly frame it is like they can determine whether or not they should hedge something based on it could just be the characteristics of the trade. Perhaps they see at some particular period in time, or whatever is above a certain size. You just pick something really stupid, like anything larger than X notional exposure on this asset needs to be hedged. It could be based on just their books more generally. There's above any trade that comes in that goes and skews their exposure on that particular asset above a certain threshold that needs to be hedged. Or it could be even based on the characteristics of the account, which is what some brokers do and starts to sort of like venture into territory that sometimes earns them a sort of negative reputation with their users because they might only hedge certain types of accounts and not other types of accounts. So in any case, so that's like broadly how the system works. It's a similar instrument to a perp, and it has a lot of the services, an audience that is, I would say, quite adjacent, has many of its own quirks, but is adjacent and has similar behavior, but abstracts away the variance that you would otherwise face. Basically, when you're trading a perp, you're kind of trading two markets. You're like tracking the spot market and the perp market. Whereas here, you're basically just trading like a synthetic levered spot instrument with the holding, like a fixed or a predictable set of holding costs, and like, trading transaction costs that are determined at sort of like at a broker level or like sub account type level. And that's particularly beneficial for sort of longer tail instruments where trying to recreate that liquidity from scratch would be a mess. And if you just think about it, just like taking a step back, there are like thousands of these types of brokers around the world. And if they were all trying to recreate, I think you mentioned this earlier when we were chatting before, in crypto, there's this conflation of like, I'll term sort of, broker, like platform, and actual exchange. And because like, Binance is effectively like the platform through which, in the Binance example, it's like the platform through which people interact with the market. Yeah. It's like they're on the UI, but it's like they also have, their own order book, the exchange itself. But I would expect in the space, and I'm like very bullish on the thesis, like anything that would directionally express the view that there will be more of a spectrum. And then there's also things that are sort of in the middle. It's not necessarily so binary, simply because like in traditional finance, it's like much more of a binary distinction because it's the distinction is more so driven by sort of like regulatory classification, whereas in crypto, it's more so driven by like, whereas in crypto, it's more driven by like I think it's been really aggregated. Like we've seen, it's like everybody who was trying to launch some perp trading platform was like trying to recreate their own native order book liquidity from scratch, which in my view is just like, I'm just leading to there's going to be a few winners, like it's going to start to consolidate, and it's going to lead to highly fragmented liquidity across all of these different sort of core base layer exchanges. And so yeah, I would be long the thesis that there will be more sort of like a splintering of specializing in a particular layer of the stack, like being like a sick front end mobile app where you just plug and route trades to whatever exchange is the most liquid on that asset at that point in time, or something a little bit more in the middle, which is sort of more akin to where we are, and I can go more into that, or just sort of like pure base exchange layer. One more thing I'd want to clarify is I think there's generally a misunderstanding, or there's this misconception that sort of like the lower down you are in the stack, the more value will accrue to you. And I really reject that view. I think the sort of like fat protocol thesis, and its consequences have been pretty bad for crypto, and it's kind of like it's given people this like mind virus. They still keep applying the same, even though it's changed, right? Like a lot of the L1s are going to zero, and now you see like perp dexes being worth billions of dollars. So things are moving towards the application layer, but people seem to, in like this like fractal way, even like within the sort of like at the app level, they seem to think that the lower down you go in the stack, necessarily the more value will occur to you. And I reject that as a general principle. If you look at like Robinhood is higher up in the stack than like a NASDAQ, and it's a more valuable business than the NASDAQ. So I think the way value is going to flow and like accrue is not perhaps as deterministic as people seem to think right now.
Yeah, I agree. I also think it just like grossly distorted valuations in general. And
yes,
it was pretty corrosive. And it also, if you think about it for more than 30 seconds, it doesn't really make sense. Like more than likely, the closer you are to the end user and the sort of like they are going to be the most, indifferent to fees and charges. I mean, I guess we're talking retail now, but yeah, I completely agree. It never made much sense. It only made sense if in the context of seeing the first few L1s, which were the only things that existed at the time, which is, I think, mainly why the valuation skyrocketed, was that there was like some illogical thinking. And then also there was just not that much, in the way of speculating and, there wasn't much to speculate on yet. So like it just, but it is going to be like a very difficult lesson to learn. But, okay. So in agreement there with going off this. So like, well, I guess you didn't like fully explain. You talked a good bit about this, like kind of CFDs, and now like maybe you could talk a little bit about how Ostium actually works, like the plumbing, if you will, and then maybe if you also want to talk about, you said we're kind of maybe in the middle of that stack, what that means in practice.
I'll start by saying, we tried to look at like what worked really well in the traditional markets and then what's worked really well in crypto, and try to learn from that and take the best of both. So the liquidity model is inspired by what we think has worked well in CFDs, in particular to offer exposure to longer tail instruments. And I would qualify, within the crypto context, like the NASDAQ, one of, or like S&P, one of the most liquid markets in the world, is actually, I would consider long tail, just simply because of, it is long tail from like within crypto, in the same way that like, you know what I mean, right? Like it's like not long tail in the, I always find it quite, as an aside, I always find it funny. I always find it quite funny that like, RWAs are considered a niche subset of crypto, and yet like crypto is actually like a niche subset of like the entire rest of financial markets. But from a crypto liquidity perspective, if we're looking at crypto liquidity, and then we're looking at how much of crypto liquidity is allocated towards traditional assets or perps on traditional assets, is a tiny, tiny fraction. And so when it comes to sort of breaking that cold start problem, so being able to offer those traditional assets in a way that doesn't have terrible liquidity and allows people to actually have a good trading experience and not face highly unpredictable, highly volatile, or very high holding costs. We thought to look at like what has worked well in the traditional markets for doing that. And then also tried to start with some basic assumptions of like, in order for this to be not just sort of a crypto play thing, which is what I would say the first instantiation of like, Mirror, Synthetix or whatever, very cool experiments and very, I think like noble experiments, but maybe, not ultimately something that was offering an experience that would be acceptable to someone in Web 2. I think the bar is simply higher, because if you want to extend beyond a crypto audience, which is ultimately sort of like, I think should be the North Star for any DeFi app, you have to take into account what the alternatives are. And it's one thing to have your alternative be like crypto levels of liquidity. It's another thing for the alternative to be able to trade for a tiny, tiny, tiny fraction of the transaction costs in crypto in huge size. And people are willing to pay a premium to trade stuff on chain, but like probably not like a 10 or a 50x premium. So we wanted a system that would give people predictability in terms of their, fees and costs. We wanted a system that would allow people to actually move size, and not face terrible price impact. And we wanted a system that would allow us to list a long tail of assets without dramatically degrading the experience by listing those assets. So with that in mind, the way the system works is we have a proprietary oracle that we built out ourselves in partnership with Stork. They operate the aggregator, and we fetch pricing from the underlying market. So a combination of exchanges and OTC data providers. We aggregate that and produce a price report every second. And when a user wants to open up a position, we quote them the price from that sort of pricing algorithm, and they're executed and netted against a pool. And then there's a selective hedging system where effectively the net exposures or net imbalances, so sort of the deltas on a per asset basis, are evaluated. And whenever they exceed a certain threshold, the position is hedged in the underlying market. So, and then rebalanced atop the sort of pool.
Wait, quickly, like when you say it's hedged in the underlying market, who's hedging that? Like just for the sake of clarity right now.
Yeah. So right now there is a sister entity that takes on certain maker positions on Ostium and then hedges in the underlying market. And the system that we're working towards, which is, I sort of outlined this in like an article that I posted on Twitter earlier in the summer, and you'll be hearing a lot more news about this in relatively short order, but will be one that will allow much more programmatic hedging and rebalancing onto a second pool. Right now, this is like private effectively, but will ultimately be an open second pool that will sit on top. So just to give like maybe a bit of background, to bootstrap the system initially, OLP took on both the function of being a settlement layer, so being able to go and settle trades, because it's not an order book system. You don't need to match a trade immediately. You just need to be able to. There's the pool is effectively sort of like the maker without actively opening another position. So the pool needed to be there both to settle positions. You might have, for instance, you might be fully delta neutral on gold. There might be 100 million long and $100 million short on gold, but someone who's making money might close their position before somebody who's losing money. And so there needs to be a pool of capital that can go in front the closing of that, basically front that P&L. Right. And so the pool is there. So that's what I would, and someone might come in the second right after and go and reset the imbalance, but there still needs to be some capital that it can effectively front for settlement. So the pool has been acting both as a settlement layer, but then also sort of a passive manager of flow. And what I mean by that is that there might be a skew on open interest. Open interest might be imbalanced on gold. It might actually be $100 million long and $50 million short. And so functionally, the pool is $50 million short in that instance, because it is actually taking on the sort of counter directional exposure. And that can be good, and it can also be bad, because it depends on how good your traders are. It depends on whether, and it depends on the way, even if maybe on average in the long run, it's like a neutral thing or actually a good thing to be on the other side at any given point in time, that might not always be the case. And, people often misunderstand sort of like probability. I guess like the natural human intuition is if it's like 50-50 shot, you get heads, tails, but like actually you get like a long string of heads and like a long string of tails. And so depending on when you sort of enter the pool or when you deposit, you might be coming in right before a long string of wins or right before a long string of losses. And if you're sort of just up to the sort of like random foibles of the market, that could be good or bad. And there needs to be, and in our view, basically, you can't effectively scale capital efficiency until and unless you have a means of systematically hedging out directional imbalances, because otherwise you have to, one, you need to be highly conservative in terms of the open interest that you can offer relative to the pool size, because of the max drawdown that should be sort of like, based on P99, whatever, max drawdown that you should be acceptable for the pool at any given point in time. And on top of that, you have to route a majority of your trading fees, so you have all of your value leaking into the pool. And this is what you saw with the early pool models. And I think part of the reason that, when they say they failed, I think they maybe don't get enough credit for the things that they did right. But why they ultimately stagnated is because they had two problems: a lack of capital efficiency and value leakage. And so if you, hopefully that kind of makes sense, right? Like you have like a pool, if the pool is like not only settling, but also taking on massive directional exposure, you need to limit how much directional exposure it could possibly take. And so you have to you have to limit capital efficiency. And then also, in order to compensate LPs for effectively that sort of trade and the potential ups and downs and the uncertainty of that trade, they have to earn a large proportion of fees. And so effectively all of your fees go towards subsidizing liquidity. And in our view, every very successful trading platform, Web 2 or Web 3, has effectively figured out how to monetize both fees and flow. And an example, like maybe give like the Robinhood example, right? They were able to completely undercut their competitors on fees and completely change the status quo on how much people should pay to trade, because they found a way to monetize the flow and effectively subsidize all of their liquidity costs and then subsidize the fees. If you look at, a Hyperliquid or any of the other sort of more recent order book models, they monetize their flow, which allows them to either, in the case of Hyperliquid, route a majority of fees to go and buying back the token, or in other instances, ultimately charge zero fees. And if you actually look at the CFD model, very similar, they internalize the flow and they selectively hedge. So they run something that's called A booking versus B booking. So B booking largely, and I'm oversimplifying here, but hopefully this will make sense. When trades come in, they have some sort of, aggregate exposure. When a trade comes in, they will programmatically decide whether to A book or B book something. If they B book it, it means they internalize it. They want to be on the other side. If you have like $100 trade that's like super levered, like there's no use in hedging that. It's probably not worth it. So they'll internalize that and they'll effectively B book it. And if there's some very, very large position that could like massively skew their books, or even just a set of positions that hit some trigger criteria, some threshold, then they'll A-book that. So they'll lay that off in, you know, with a partner.
It's actually quite similar to how the sports books do it. In fact, like,
yes, it is very similar. Yes.
Yeah.
So
the thing I do wonder, go ahead.
Yeah. So what I was just going to say is basically like the thing that all these models have in common, they have different ways of doing it, is they figured out how to monetize flow in order to, at minimum, subsidize their liquidity costs, which are always the biggest costs for a sort of trading platform. And ideally, and in the case of when they do this very, very well, they monetize their flow so well that it not only subsidizes liquidity, but ultimately is there then, you know, goes beyond that and becomes like a source of profitability, allowing them to either completely undercut competitors on fees and charge less. And if you look at this in the CFD world, like it's been a complete race to zero on fees, as it has in you know, on other sorts of trading platforms. You're even seeing that in crypto right now, or, you know, distribute those like fees that they collect as, you know, dividends, or, you know, in the case in crypto, maybe like a token buyback.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while building some of the most interesting products in the space. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. They're backed by Paradigm, Electric Capital, and Han Ventures. The founders, Eugene and Jerry, have experience at Citadel, Jane Street, and the Solana Core team. Since launching their order book DEX, Phoenix, they've done over $80 billion in trading volume by making on-chain order books competitive with centralized exchanges. They are also the team behind Gavel and SolFi. I would consider them the foremost experts in crypto market microstructure. The best part is Ellipsis is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer who wants to work on infrastructure that's already proving itself in the market, go to ellipsislabs.xyz. Okay, now back to the show.
One thing that is different with Robinhood is that they can KYC the users, and they can make sure that people clicking on the Robinhood app are not toxic. And that's in large part why. And so I do wonder and this is like, if everybody on the other side of the Robinhood book, right, was like, okay, Citadel's on one side. If HRT is everybody on the other side, they can't do this, right? This doesn't work like this, right? Because it's like almost going to be all toxic flow. With crypto, it does seem like a bit more difficult because anybody can make a wallet, right? And we're seeing this a little bit like a similar thing in Solana right now with these prop AMMs, where it's kind of like this cat and mouse game where, you know, you're trying to figure out when Wintermute is on the other side of it. And then more often than not, you want to take it, right? Like you want to quote like super tight, but then you never know when Wintermute spun up another 1,000 wallets, right? And so like, I do wonder with crypto, if this is, I won't say intractable problem. Like, I know like Lighter, for example, they're charging API access. And if, I guess the assumption there is, if you were, for example, a toxic taker, you would, the fees for API access would be too much to basically, you know, like pick off orders. I don't know. Do you have thoughts with regards to decentralized trading specifically, where you don't really know who's on the other side of these trades, right? Like Robinhood knows who always is on the other side. Crypto may be a bit more difficult. You could like get into some precarious situations with who's kind of like taking and whether or not it may be toxic.
Yeah, this is a great question. I mean, I think it's just inherently harder. Yeah, you're welcome. I think I'm saying like the obvious here. It's definitely like just inherently more difficult. And I will point out that, I mean, what you said on the Robinhood example is even more so the case in the CFDs. And they do have, you know, without naming names, like there's a pretty like storied history. I would, you know, you just go through the subreddits for some of the large like CFDs and see what people are complaining about. If you Google like CFD broker closed my account in profit, you're going to find a lot of complaints. And I mean, they do this. They'll often, and even like, I mean, Marco and I, when we were like just out of college, we had accounts on many of these different brokers and would run like delta neutral strategies. And like, I mean, Marco's gotten kicked off a bunch of them. Because if you're running, because often they would like allow you to do stuff like, you know, go 20x levered beyond meat the night before earnings. And like that stock moves like, you know, can move 20-25% on earnings. So you know, you just do it on two different accounts. So anyways, you know, you do this sort of stuff and they are like hawks for catching this and just kicking you off. And they're ruthless. Like, because you basically have no protections as a trader. Like if they want to keep all your initial deposits and like just cite their, you know, terms of use, like they can do that.
It's the same thing with sports, like DraftKings, you know?
Yeah, it's within their purview. Like they're like, yeah, totally. Like they'll kick you off. So that's how they deal with it. And I think a lot of the downside is though, like they wind up losing a lot of trust doing this. And like clearly it is like game theory optimal for them to do this right now. But our view is like it's not going to be game theory optimal for them to do that anymore once there are alternatives that are credibly neutral, where you can actually like credibly claim like we won't kick you off, like we can't kick you off. They can all sort of get away with doing it right now because like they all do it, so it's kind of like they're all kind of like in on the joke. But when you have an alternative that is like credibly neutral, I think it'll completely change the game. The problem then is like how you deal with the toxic flow. And the answer is, so there are ways, by the way, that like even the CFD brokers deal with it. They have things called like speed bumps, for instance. They all have all sorts of, fun tricks for trying to mitigate beyond, the sort of like closing someone's account is their like last resort. But they have all sorts of tricks before that. For instance, if like a really large order comes in, they'll have like some price feed, but if a really large order comes in, they won't actually quote you that price. They'll go and get a quote for the cost that, the quote that they would get to actually go and hedge it, because they have to lay that off before they offer you that. So, and they don't tell you this programmatically. So sometimes like if you're trading in very large size, like liquidity, especially on like, or even just normal size on like a, whatever you want to turn normal and being maybe a little bit more general, but on like a longer tail asset, liquidity might just dry up because it triggers the risk model and they won't let you open that trade. Yeah. So they have all sorts of sneaky ways. Like the answer is like, I don't think it's definitely not like a fully solved problem in crypto. I think it's going to take a while. But the latency, I mean, there's so many different, like a latency arb, for instance, like that's sort of a classic one. You can prevent simply by setting, fees sufficiently high, which you can get away with doing in crypto right now because there is demand and people are, you can charge a premium. Like clearly you can charge a premium for doing this stuff on chain. So that can help you. Like the devil's really in the, I think the programmatic system in terms of like charging makers for API access on Lighter is like a very, very smart one. In terms of like, there are sort of catch-all systems. And then there's like small tweaks that you can do at the level of like, okay, the fees for this asset that maybe is a little bit less liquid, or maybe you might be getting quotes a little bit less infrequently, need to be a little bit higher on the margin because the risk of some latency arb is slightly higher. So there are all these sorts of like little risk management things that you need to implement. Again, you can learn a lot of that from what they do on these like traditional brokers. Like there's certain things you can't do. You can't do the like end game of like, blocking accounts. That would violate the entire sort of principle of doing this on chain. And that is like, I think is like sacrosanct. Like you should never even consider going into that territory. So you need to have, I don't know, just getting philosophical. This is like why it's hard to build in crypto, right? Like it's like, you gotta like open source your code. Anybody can read your contracts.
Yeah. I think also and I've seen this with regards to prediction markets recently, and not that I'm like so much an expert on sports books, but I have maybe a little bit like more context. And I think that a lot of times in crypto, people, they make this assumption that there's like all these entrenched actors within TradFi and they're parasites, and like they are, they've done nothing but extract from retail, and crypto is like this, this new light, right? And it is like this new way to do things, but they don't realize that like the reason that Robinhood can give you 0 fees and the reason you actually get better execution on Robinhood is because Citadel knows that they're not trading against HRT or SIG, right? And so like in many times, like and this is sort of one of these examples, and I've seen this with prediction markets too, where people think that like intuitively peer-to-peer betting should just be like much more efficient market. But the reality is that like makers, also there's this whole thing with like, it's a side note, but like court siding and like, when it's an order book model and it's, on a decentralized platform, like can you just front run makers or whatever?
Yeah.
And they think that like, oh, well, this is going to be a much more efficient way to do things. And in reality, like, makers just aren't going to make markets if they don't have perfect information. Like they're not gambling, right? Like, and so I think oftentimes there's this assumption, and this applies to like all different things in crypto, where we think it's being done wrong in TradFi. Maybe in some capacities it is, but it's not necessarily for the reasons people think. And there's actually like some like obvious benefits to,
okay, maybe we don't all love KYC, but it's also why Robinhood is able to do what it's able to do. And it's able to throw off people who are picking off quotes and stuff. So yeah, it's like, it is interesting. I think it must be hard.
We should aspire to smarter ways of doing it. Like there's like it's kind of like easy mode to just be able to like KYC people. I think there are smarter, more, programmatic ways of doing it, but it is a thornier problem. And you were just saying something on, Robinhood, like the reason they can quote you zero fees. Like, there's like, national best bidder offer, like NBBO, like the prices of whoever is quoting you has to be at least better than, NBBO. So you are genuinely getting like a good price. And you're genuinely paying zero in fees, but like, you also have to accept that there's going to be a market maker on the other side.
So I quick question. It's like something I also thought about. You talked about how you built this like proprietary Oracle, or I don't know, in conjunction with Stork. Where do those price feeds come from? Is it like Bloomberg or something like that?
So it's a combination of like direct from exchange data and OTC data sources. So you can't reveal, there are a few like, there are licensing requirements for those data feeds. They're not super easy to come by for the really high quality feeds. And there are also restrictions on sort of like display and what you can reveal. So you can't reveal like, if stuff is coming in at like a tick level, you can't actually reveal that to the user. So you have to do, there's
why do they care? Why do they care if they're just like selling this to you out of curiosity?
It's their business. Because they would have to charge you like orders of magnitude more if you were displaying the actual, if you're displaying the actual underlying data and anybody can go and pull that and see it, then you're just completely undercut.
I see. Yeah, you're just like running it through. Just steal it. Okay.
Yeah, then they would have to charge you like way more based on. Then they'd have to charge you based on like consumption. And if you have, it's like free money basically. Like it's free data that otherwise people would have to pay like tens or hundreds of thousands of dollars for. So if you don't, there have to be there are. You can't reveal like the tick level data itself.
Got it.
But there are sort of like, it's called like a non-display way of getting the data out there. And you just kind of have to have like a proprietary like pricing system where you're aggregating it, you're weighting things. You can't really infer the actual tick level data back. And for anything that's sort of like, a normal retail like use case, people are not trading at like a millisecond level, like 1 second latency is perfectly reasonable in most instances.
Okay, you had this tweet where got quite a lot of attention on Twitter, and it was basically showing that there was like 365% funding on, I don't know what asset it was.
It was on the XYZ 100, yeah.
Okay, so this is like the Synthetix NASDAQ. Okay. Like what is kind of the point you're getting at here? Just that like the funding rate's quite unpredictable, or that there's a funding rate to begin with? Like, walk me through this. Also, obviously this is just like topic du jour. That's why it's interesting.
Yeah, people got very angry about that tweet.
It's like good engagement bait though, right? Like I think a lot more people know about Ostium now.
It wound up being great for us, which probably to the chagrin of our haters. But I definitely underestimated like how easily misinterpreted something you say can be. But ultimately, wound up being great for us. We've done this has been our highest volume week in like stocks ever. We listed a bunch of new stocks this week. So worked out very well for us. But the point I was making was about the magnitude, not the direction, but the magnitude of the funding rate. And my point was, this goes back to what I was saying earlier in the pod about trading like one price versus two prices. Like you're trading one market or you're trading another market. Like if I want to bet on the NASDAQ, if I'm going to hold a position for a few days, and like, yes, Perps is not holding a position for like a year, but certainly, a lot of the people on our platform will hold positions for a few days, for a few weeks. We even had people hold positions for a month plus. If suddenly you have a funding rate that can randomly spike to triple digits, that's going to wind up having a much greater impact on your P&L, potentially, depending, on your leverage, than the actual price change of the asset itself. And maybe crypto traders are willing to tolerate that on crypto that can move, many percentages in a day and is highly volatile. And also they've kind of gotten used to it, which is like, I don't, again, going back to what I was saying earlier, like if there's an alternative where they don't really have to get used to that, I'm not sure how long. It's this weird quirk of the market that people are sort of like willing to tolerate it. Obviously funding rates have sort of come down with the, advent of yield products like Athena that have sort of like started to arb that stuff out reliably. But writ large, people are obviously willing to pay for, leverage on things that are very volatile. But well, one, again, going back to what I was saying before about like the North Star of you ultimately, like your bar, if you're building a product in crypto, should be that it should be something ultimately you should aspire to building something that has a user experience that someone who's not in crypto today would be willing to tolerate. And I think simply like, to date, people haven't really built with that in mind. And so people have, I think, anyways, not to rough too much, but like you should take into account what the alternatives are. And if people might be subject to a 3-digit funding rate in one direction or the other, it will wind up having a massive impact on their P&L. And they wind up needing to pay more attention to the random price, like cost changes and holding their position than to almost the fluctuation in price of the asset that they're trying to trade. And crypto traders might be willing to tolerate that. But if you're trying to expand into sort of more, normie, whatever you want to call it, my bet is people are not going to be, that's why I said like, non-crypto traders are going to love this. People are going to be much less willing to tolerate that. And that is like how that has sort of been the promise of these products. Like, oh my God. And I've been saying this for a long time. Like people are not trading options per se on stocks because like that's the best instrument for them to do so, but because like that's just the only way they can really get leverage today.
But I guess, okay, so what would have been the equivalent on Ostium? Like, contrast this with, okay, on Ostium, you're paying this much less in.
So to long, we just have basically like a very, very sort of reliable set fee that on the long side that charges based on like just some small premium on the Fed rate. So it's like a 5% right now on NASDAQ and S&P. Yeah.
Yeah. So, but it seems like your vision is more such that we can do these things like synthetically now. We can bring them onto like a open permissionless platform, and that is preferable to trying to like truly bootstrap the order book on chain, right? Like that's the premise. Is that directly correct?
That's correct. And I would say it's almost like, feels like almost like an ego game trying to like recreate NASDAQ liquidity for an asset. Like I like these assets are super, super liquid. I think the benefit, and people might, disagree with me. I think to be clear, like there's value in experimentation with many different models and people approach it in different ways. And I think competitiveness, like, it's actually like, it's great to have competitors. I think it's like you want multiple people building the space because it validates that it's a huge market and ultimately makes everybody better. But that said, I think if what you're trying to aim for is offer a good trading experience, and different people value different things. I mean, like if you're running arbitrage strategies, like that's great. But if you're just someone who wants to punt directionally on the NASDAQ, if suddenly, your position is just like down massively over the weekend. And the problem is like, because they're also offering continuous trading over the weekend.
Yeah, that was the next thing I was going to say. Go ahead.
Yeah, they're offering, when you try to do this through like a 24/7 perp model, and you offer continuous pricing over the weekend. It's very cool conceptually, but I disagree that like, I don't think it's a good trading experience. It's one thing to be like, one, I don't think there are very many people per se who are actually like looking, if you want to scale into a large position, you're just not going to do it over the weekend because the market's just not liquid. So you're going to do that during the most liquid market hours, one. So you're servicing a very small subset of the people who actually want to trade the thing. So I don't know how much like value you're providing. And my argument would be, at least in the near term, again, long term, all of these markets are going to go 24/7. I just think that the liquidity and the value in having a 24/7 market on chain on an asset that's not 24/7 by default is only going to get to a good point when the underlying market also gets to 24/7. Like,
I think
we're going to converge at the same time.
I think maybe the counterpoint, you can disagree with this, and I don't really personally have an opinion, but I think the counterpoint is that like a lot of the ideals, from what I can tell in crypto, are that I mean, crypto collectively has to push the bounds in order for
that I completely agree with.
Yeah, so I think maybe so you see people.
But I think it's one thing to say this is a good charity thing to do, and it's another thing to say that this leads to a good user experience. I don't disagree.
But I'm not sure that, like, for example, with the XYZ100 thing, it was out like what, 1 day or 2 days when, like, I mean, of course this is not a mature market yet. They're in the arena trying things, but like I'm not saying seeing 365% funding is like, okay, not ideal, but I think that one of the arguments is like, look, like Uber wouldn't have been successful if they didn't break all the laws, right? And like, so and I'm not saying necessarily breaking the laws, but just like doing things that others wouldn't. So, and I'm not saying that you necessarily disagree with that either, that we have to like push the bounds such that TradFi catches up to us because nobody else is going to do that. But I guess that would be the only like sort of counterpoint. And I don't know that anybody is really arguing it's like a fantastic trading experience and also gaps weird in on the weekends as well. Like, let me ask, what happens with I don't know, like some of your just weekday markets? What happens when they close on Ostium? I think, does it just like auto close a position or what?
No, it doesn't auto close positions. You can hold positions over the weekend. We just don't allow you to open new positions or close your positions. So, you can add collateral. Yeah, you can add collateral if you're worried, for instance, like, let's say you're, short oil and there's like some massive geopolitical disruption over the weekend that's going to, pump oil when at, market reopens Sunday night. You can top up your position to make sure you're not going to get liquidated when the market reopens. So you can add.
But does it tick? Does it tick on the weekends or no? It's like you're like locked in it. Okay, so it just like sits there as like a single dollar denominated amount.
Yeah,
got it.
And I'll just give you an example to like. I mean, there's a slight difference between like the way there's one. I should probably write more about this, but like the first way that people have tried to implement RWA perps has been by referencing the spot price that they referenced would be the tokenized asset, right? So Pax Gold, there were Pax Gold perps. That was for sort of the first wave of these RWA perps. Well, I mean, I'm sure you saw this on October 10th, Pax Gold wicked down to like 3,000. And then 6 days later, it wicked up to 5,000. So you had people like personally know traders who were double liquidated. They like rotated they were like bearish crypto. So they rotated into gold. They were long gold and they got liquidated on the way down. And then they wanted to short gold because gold was pumping like a crazy amount. And then they got, they were right directionally, but they got liquidated because of the wick up. And it would have been way better. The crazy thing is like that October 10th stuff happened after the underlying markets closed. Like the gold market was not open. So if you had held your position on Ostium, no, you would not have been liquid. I mean, depending on how leverage you were when the market reopened on Sunday, but no, you would not have been liquidated. It's just insane because, again, going back to the principle of trading one market versus two markets or even three markets in this instance, like if I'm trading gold, I want to trade gold. I do not want to trade gold with the random liquidity dynamics of crypto, wherein when the crypto market is tanking, all the liquidity on gold dries up and I risk getting, just completely obliterated because crypto liquidity dried up. I want to face the liquidity dynamics of the underlying market. I don't want to be subject to, and I think I think what people fail to grasp is like, it's one thing for like long tail alts because like, yes, the perp market on the long tail alt is going to be illiquid, but like, guess what? Like the spot market is also illiquid. And you kind of know when you're trading that, okay, maybe you're like not anticipating that all liquidity is going to get pulled and it's going to go to like 0.01, but you're definitely aware of the fact that it might drop 50%. You're not baking that into your risk model when you're trying to trade Tesla or gold or the NASDAQ, that the thing might wick down like, 50%. That's not, I mean, it like should be right if you're trading the like pure crypto native perp, but like that's not an ideal. So again, like, and maybe I'll just like, because you commented sort of like, people being in the arena and all this stuff. As I said before, and it's hard for nuance to come across on Twitter. Like competition is great because it means it's a big market and it means that it's going to make everybody sharper. So that's great.
I guess like one other thing I would say, and this is, I'm alluding to this tweet, but now I'm just talking more broadly. I think, from what I hear, and you can tell me if I'm putting words in your mouth, but like from what I hear, and at least in its current form, Ostium does not believe that price discovery will happen on chain. And I would say
maybe 10 years.
Okay, but given like your maybe current like short to medium term, so maybe like then I'll probe there. In 10 years, does NASDAQ and does Tesla price discovery happen on chain.
Maybe. And if that's true, we'll quote there. But it's just not true now.
Okay.
So I'm mostly interested in offering a good trading
Yeah.
experience with like, you know, good execution and predictable holding costs.
Yeah.
So we quote the most liquid market.
Right.
Yeah.
Yeah. No, and I think, you know, if you're talking about like purely where you're going to find the most efficient pricing, you're pulling it from where it's sourced is like, I mean, I'd have no arguments there. I guess that is one, that is an additional point, right? And maybe we could put aside like the XYZ 100 thing, but that's an additional point. Just like, I think that at least some people are trying to make price discovery happen on chain. I don't know where it's happening on chain anywhere right now. Maybe some of the deepest pairs on Hyperliquid, I'm not sure, but regardless, I mean, it's probably happening on Binance. And then as you get on the list, everything, the only thing, right, is maybe like the longest tails assets, like, you know, a meme coin with a $5 million market cap. Yeah, of course. Like, but that's totally a different discussion. So, but yeah, like that would be the only other like kind of counterpoint that I provide. It's not my counterpoint. It's just a counterpoint, which is that I think these people believe in like deep order book liquidity on chain for these things. And that's what they're trying to kind of get to right now. But yeah, maybe the trading experience is obviously not
I would
ideal.
just say the two things play into each other. Again, what I was saying on competition being good, it's like, look, arbitrageurs should be thrilled that we exist. Because if they want to arb out the massive funding rates on Hyperliquid, it's very hard to do that, to go and manage. It's one thing to try to manage your collateral between, you know, arbing out like a, you know, some shitcoin on Hyperliquid or, you know, wherever, and Binance or OKX, and managing your collateral and sending your USDC back and forth. It's another thing to do that if you have to send it back and forth to like an IBKR account or you know, wherever. They could just go and do that and take the other side directly on chain and face extremely predictable holding costs and extremely, you know, predictable pricing. So I, you know, open call to all arbitrageurs. If you want to arb out the funding rates on XYZ, do it. Like, you know, don't make both better. Like, just come and, you know, come over the weekend and arb out the crazy spikes in funding rates and put your offsetting position on Ostium. Yeah. So
the other thing too is I have two more questions. The other thing was that you guys have 24/5 markets. Is that right?
Yeah, it depends. It depends on what. So like FX is 24/5. It really, again, we're just following the underlying market hours. Commodities and the indices are 23/5, and then the stocks are less than that.
Got it. Okay. All right. And then last question is like kind of just zooming out, and also something that I'm curious about. Yeah, and I've asked other people about this, but I don't know that I have like a really good grasp on. For Perps, and then just broadly speaking, also like whatever you want to consider kind of Ostium, do you think that large institutional actors, like maybe a hedge fund, like let's say they want to take a 3-month leverage position on, I don't know, Tesla, is a Perp or Ostium or something like the way we've designed these, I won't say CFD, but something similar to a CFD on chain, is this something that they would use? And like, well, I guess what I'm asking here is they have access to like bespoke, you know, OTC margin and options, and they can like, you know, go to investment banks and have them design all sorts of types of products and derivatives for them. They can use a margin account. Like there's a lot of ways to get access to leverage for a hedge fund. Do you think a hedge fund in the future would use something like a Perp, or what would be the reason behind that versus what they currently, you know, kind of have available in your mind? Like when does this scale up to like the biggest players in the market wanting to use these type of products versus what they may currently have? And put aside like the crypto inefficiencies right now. Just talk about like the actual like in an idealized world. Why would a hedge fund use this for leverage?
I think it's hard to just put aside the, well, okay, maybe putting aside the like very near term crypto inefficiencies.
Yeah, that's what I'm talking about.
Like more broadly though, I'm not saying this like particular example, but just like I think it's like a pretty consensus take that like writ large funding rigs can spike dramatically during periods of, you know, high volatility or uncertainty, and you know, or the book can just be consistently skewed in one direction, so you're consistently paying like, you know, it takes a while. Like funding rates are consistently like higher than maybe other sort of carry costs, and part of that is just like the market structure today. But what I would say is like they're not like the best instrument for holding something long term. Right. And this was actually kind of people's like counterpoint to my tweet. They were like, well, nobody's holding anything for months. Like no one's like, you know, holding a Perp position on the NASDAQ for like months or years. Like, yeah, like that's true actually. So I wouldn't, I mean, in your specific example, would like a major fund that had wanted to take like a 3-month position on Tesla, would they use like a Perp to do that? I if they have, access to every institutional product under the sun, I would say probably not. I don't think perps are the optimal instrument. Like as implemented today, like I don't think they're the optimal instrument for holding a position over like a multi-month period.
But the reason, so then like going off this, then like the reason I say this is, are perps strictly useful for retail degeneracy? Like I'm trying to figure out where the next step up is, right? Like I am in agreement that perps are better than options. Like I think they're much more intuitive. I look at them like, oh yeah, I see what's happening. Like I'm 10x long here and I'm paying a little bit, or 50x long. Right? But the point, like it makes sense. Oh, like, it moved up 1%. Okay, I'm up 10%. Like it makes sense. But so like compared to options, right? It's like very obvious why retail like would prefer perps or a perp like instrument. Is that all that they're useful for in your mind, or like where else?
No, well, okay, maybe just to qualify your initial question a little bit more, right? Like there tends to be a systematic long bias on perps, and that's probably even more so the case with retail, because retail tends to be systematically long biased. So yeah, if you're a fund, let's say, and you have some large long position or some large long, you've taken a large position in Tesla, but you want to partially hedge some of that in some form. Maybe you want to, I don't know, you maybe want to beta hedge it or whatever. You want to partially hedge some amount of that exposure, or maybe over some time, even some subset of that time period. Like, yeah, you could get paid to go short. So, yeah. That's definitely, there's real value in that. I was answering your question more so of like, I want to take a long position on this thing over a multi-month period. And I'm a giant fund. Like, am I going to use a perp? Like, probably not. But if I have some other instrument I'm using and I maybe want to partially hedge it or whatever it is, like, I think like perps are like useful for an institution insofar as they allow you to arb the market and, collect funding. Less so for like expressing like a long-term view on an asset on the long side.
Okay. Well, I think it's been fantastic. I think we covered everything. We covered everything in your mind.
Covered a lot of stuff. Yeah.
Yeah.
There's a lot more stuff, but we covered a lot of stuff.
Okay, well, maybe we can do it again. So, all right. Well, thank you so much. It's fantastic.
Thanks for having me.